Hey guys, Sean here from SGT Report, and on the line is one of our favorite guests, Alasdair Macleod from goldmoney.com and his own site, financeandeconomics.org. Also on the line is our longtime friend and contributor, Rory. How are you, gentlemen?
We're very well, or at least I am. I hope you are, Rory.
I am. I'm doing quite well.
Gentlemen,
I'm down here in Biloxi with the Hand of Faith gold nugget. It's the world's largest publicly displayed gold nugget. Weighs 61 pounds, 11 ounces.
Ooh, I wish I had that. I once went to a gold mine in New Zealand as a tourist, and there's a graveyard there. And the grave of one chap had a gravestone over it, and it said, "Died in despair." So I think that's what gold mining is all about, unfortunately.
Well, you know, Alasdair, as I've always said, I think it's amazing. It truly is, and I'm not preaching, I guess I am preaching to the choir here, but I think it's truly amazing that we are still living in an environment where we can take this crazy fiat paper that is only backed by the confidence of the sheeple and exchange it for real tangible precious metals that really are pulled from the ground at the expense of blood, sweat, tears, energy. And to me, it's just amazing. It still is amazing to be able to trade a $20 bill for 1 ounce of silver. It's stunning. And
aren't we lucky?
I think so, and it looks like we may remain lucky for a time to come. One of the first things I wanted to talk with you about today, Alasdair, is this breaking news that was released essentially on Friday that there will be no free market pricing for silver. The 117-year-old silver fix isn't really ending. It's merely changing hands, as we noted at SGT Report. Let me just read this to you fellas. According to CPM Group, about $5 trillion of silver is circulated globally, at least in 2013. As you guys know, CPM Group is headed up by everyone's favorite shill, Jeffrey Christian, and I noted that $5 trillion of silver is 250 times the amount of physical mined annually. But here's the point. The CME Group and Thomson Reuters Corporation will run the replacement for the 117-year-old silver fixing benchmark that's ending in August, the LBMA said. They're going to run a test of this thing on August 15th, Alasdair. And according to, what's this fellow's name down at the bottom? According to Nick Brown, head of commodities research at Natixis SA in London, quote, if the new silver fix is seen as a clear success, then that might encourage calls for it to be used as a blueprint for the new gold fix. So I just want to be clear, Alasdair, correct me if I'm wrong. It sounds to me like they are rolling out a new silver fix, but this one will just be an electronic fix. What's your take?
Yeah, I mean, we don't know the answer to that question at the moment, but I think you're right. It looks to me like they're using CME's platform, and I'm not quite sure what Thomson Reuters' involvement in this is, but I don't know, coordination or something. I think we have to bear in mind that the London bullion market is likely to go through quite a lot of transition. And the reason for this is that there was a Treasury Committee meeting where they called in the regulators to talk about the subject of the gold fix and the gold market as a whole. And what came out of that was really very, very negative as far as the way the market runs at the moment. Now, this tells me that even though the members of the London Bullion Market Association feel that there isn't a problem and that they should continue without material change, I think the regulator is going to be forced to take a different view. We're looking at a market which, I mean, you said that the silver fix has been going for the last 100 years or whatever. I mean, it's, yeah, wonderful, great. But markets change, and London hasn't recognized this. We now have a situation where London is an over-the-counter market, which gives minimal information about turnover, about trading, about members' exposure, and so on and so forth. Whereas if you go out to Shanghai, I mean, the Chinese, for goodness sake, they give you the full information on the Shanghai Gold Exchange as if gold was actually an investable asset as far as, you know, for regulatory purposes. And that is what London has got to compete with in the future. For a start, the business is moving out to Asia. If they're going to keep business in London, then they have got to really modernize. And I think just talking about the fix is actually to miss that big basic point. What I would see, therefore, is that in the coming months, you're likely to find that the debate shifts away from purely about the fix, but about the future of the market as a whole. And I think that they just don't give out enough information for London to retain its position as the major trading centre in Europe. In the future, they've got to look towards the future, and at the moment, the members are not doing that.
Well, I think that your quote there is a good one. Markets change, and London has failed to recognize this. I think you're right. It fascinates me that they are rolling out this new electronic fix and calling it a fix. Again, hiding in plain sight. They've fixed the price of silver and they've fixed the price of gold. Literally, they've colluded in pricing mechanisms for over a century. And it is their intention, I think, Alasdair, despite the fact that markets have changed, to do that again. They want to continue to do that again. They want to continue to do business as usual. Meanwhile, the rest of the world is looking at these clowns saying, we can see you. The curtain's been opened. We can see you. We see you there, idiots. Now, you're going to have to change your business practices or you're going to lose control permanently. And I guess the reason I want to beat this to death a little bit is that Zero Hedge followed up on that news, and I called it outrageous but unsurprising. CME Reuters picked to replace silver fixing supervised by former gold fixer. Zero Hedge notes Jonathan Spell. Jonathan Spell. Where have we heard that name before? Oh yes, recall, from Rothschild to Koch Industries, meet the people who fix the price of gold, referencing a previous article they did. I just want to read this to you guys. The person in charge of navigating the transition from the old fixing mechanism, of which he was part as recently as April, was a person who was, drum roll please, supervising said transition. Surely his consulting was fair and impartial, right?
I think we get the idea.
Yeah, he was rewarded by the LBMA to conduct an independent review of the applicant to run the silver fix. I'm sorry, my point is that it's the same band of bad guys that want control over this new system, and they're using the same band of old guys to implement the new system.
Well, I think the judgment you're making that these are bad guys, I'm afraid, is a judgment that many, many people are likely to make, so long as the whole thing is run like a club. I mean, whether they're good or bad, we actually don't know, and that is the point. If anyone wants to come up with a conspiracy theory, they have done nothing to defuse, the vaguest possibilities that any conspiracy theory might be right. And I think there is a parallel episode to this. If you go back to the mid-1980s, we had something in London called the Big Bang. And central to the Big Bang was the end of the London Stock Exchange in its previous form. Now, I can tell you, having been a member of the London Stock Exchange at that time, there was not one London Stock Exchange member who thought that any good would come out of Big Bang, other than the banks were giving lots and lots of money to the partners of existing firms to buy them out. But beyond that, anyone who really seriously thought about it thought that this was a bad step because there was going to be conflicts of interest and all the rest of it. And that was dealt with the idea of the Chinese wall and so on. And, nobody talks about that anymore. And the reality is that when you get into a situation such as the London Stock Exchange got to in the 1980s, then it doesn't matter how good the people in the market are. There comes a point where that market cannot evolve to deal with the potential, with the new markets as they're likely to evolve worldwide. And London had to change. Now, I see the same sort of crucial point with the London gold market. At that time, when Big Bang happened, they decided what was going to be, if you like, a regulated investment. Stocks and shares were, derivatives were. Those were regulated investments. What was not a regulated investment were physical metals, both base metals and also precious metals. They were excluded. Therefore, they could go and they could be dealt with whichever way those markets wanted to deal with them. It was not an affair of the regulator. The regulator was obviously interested in the participants if they themselves were regulated. For example, a major bank would be regulated and they would be expected to behave, if you like, in a sort of proper manner when it comes to dealing in an unregulated market. But essentially we now have in London this sort of split between regulated investments and other media which are not regulated. And that is creating, I think, a bit of a friction, and it's a bit of a problem. And it's something that needs to be resolved. And it particularly needs to be resolved because we've now got things like ETFs have come into it. What is the status of the bullion that is held to secure an ETF, for example? There is some confusion over that. There is the situation with derivatives. I mean, the derivatives that are regulated are futures and options. Why are forwards not regulated? So you have got all these very, very important points that haven't been properly considered. Now that we have this problem in London, and the problem is a bit deeper than just the fix, by the way, I think that we're likely to see a complete overhaul of the way these markets operate. And this is the chance to do it. And the politicians are getting involved, which really means that the members of the LBMA, they're no longer in control of their market in the way in which they would like. And I think that's a very important point to bear in mind. And if I can just go on a little bit, one of the things that's triggered this, of course, has been the role of Deutsche Bank. Deutsche Bank were investigated and are still being investigated by their regulator in Germany, BaFin. And BaFin has requested that Deutsche Bank sends all details of dealings in precious metals and returns them to the regulator. What that did, now it may be coincidence, but it seems a very odd coincidence. Deutsche Bank at that stage decided to withdraw from the silver fix and to put their London seat on the market. It turns out that there were no buyers for that for the gold fix in London.
Right.
Now that in turn tells me that the in-house lawyers and the compliance officers in the banks who might have been interested in bidding for that, even though it's a pretty lucrative business having a seat on the London gold fix, have advised senior management, no, I don't think we participate in this. That to me is the most telling thing. If nobody is prepared to buy into this opportunity, then there is something fundamentally wrong with the market. We don't know what it is at this stage, but this has got to be opened up and cleaned, and it's got to be publicly cleaned in order for the world to continue to have confidence or to retain confidence that London is actually a fair and just place to deal in.
Yes, sir. Totally agree. And you're such a gentleman. I want to say two things. Number one, as it pertains to that gold seat, we know that the Rothschilds got rid of their seat on the gold fix.
Yeah, that's right. I mean, they had this. That's right. I think it was about 2004, 2005. I thought that was very odd at the time, but there was never any explanation.
Right. I think they saw the smoke coming from the fire, and I think the reason that Deutsche Bank couldn't sell its seat is because nobody wants to be accountable for this hundreds and hundreds times paper versus the actual physical on hand. But I do want to say one thing. I want to circle back. When I said bad guys, you're such a gentleman, Alasdair. What I meant was they want business as usual and they don't want a free market. These are the crony capitalists. These are the insiders. And to me, those are the bad guys.
Yeah, they think that they are actually running a free market. This is the problem. And it's exactly the same. This is why I referred back to the stock exchange in the mid-1980s. We thought we were running a free market.
But
of
fix
course,
is the opposite. It's the antithesis of a free market. It's called a fix for a reason, right?
Well, yeah, but not quite in that sense. What a fix does, in theory, is it brings together business which would otherwise occur at other times of the day towards a common point, and in theory, it increases the liquidity in the market. Now, most of the time, I think that's probably right. But whenever you have something that distorts the market, you have something that can be gamed, as we saw with Barclays. Barclays were found out gaming it.
That's right.
The FSA looked at this and said that we have seen no other instances of this happening. But I don't know whether it's happened in the past or not. But all I know is the whole system has been its credibility has been called into question, and that is something that needs to be addressed. And you can't address it merely by saying, well, there's nothing wrong, therefore it should be business as normal.
And let's just be clear about other commodities, Alasdair. Are there any other commodities for which there is a twice daily fix?
I think platinum is. And of course, you see, the other thing is that, with metals, you've got it with LIBOR, and you have it with foreign exchange, I believe. There are entities that like to have a reference point that they say this was the price on that day, and for some reason they think it's not sufficient to know that the closing price in London might be a figure. Now, if we had a proper market in London, we would know what the closing price of gold is. And that would be the reference point.
Yeah.
And I think, you've already got that on COMEX. I mean, you get a closing price on COMEX for gold, silver, and, all the other things. What's wrong with that?
Right.
I don't think you really need a fix for a reference point.
Before I throw it over to Rory to ask about unwinding unallocated gold accounts and getting a bail-ins update, and you guys can hash over which we talk about first, I think we need to flush this out, Alasdair, as it pertains to all the paper silver and paper gold in the market. And the reason that this gold-silver fix is outdated is because Nicholas Larkin from Bloomberg refers to $5 trillion annually traded in silver, at least in 2013. And in the same article, he notes $18 trillion of gold. Well, how does that add up? Number one, my concern about $5 trillion of paper silver trading hands in 2013 is that's 250 times the amount of physical pulled out of the earth in 1 year, right? So if they're mining 1 billion ounces, let's call it, truly it's closer to 700 to 800 million, but let's call it 1 billion. 1 billion times $20 an ounce is $20 billion, and $20 billion goes into 5 trillion 250 times. Now, in the same article, he notes $18 trillion of gold traded hands in 2013. Well, does anybody else see the problem with that figure? 5 trillion in silver, 18 trillion in gold, when the silver to gold ratio is 60 to 1. Nicholas Larkin argues that the silver to gold ratio is closer to 3 or 4 to 1, at least in the paper market. These are stunning figures, and it gives a thinking person cause for pause.
Yes, it does. And I don't know what to add to that. You're looking at turnover in a market rather than settlement figures. But to my mind, there is huge confusion about what actually is turnover and what actually is settlement. You'll get monthly figures out of the LBMA, which shows, in effect, settlements at the end of the day. Now, a lot of the settlements involve gold that doesn't move at all. And, one wonders to what extent a settlement, because it hasn't actually resulted in a physical movement of gold, has probably been put off, if you like, by further forwards. I mean, to my mind, the whole thing is just not clear. What they do in London is they use gold as the basis of financing an awful lot of business. And it's very, very clever. And, you can... again, according to Jeffrey Christensen, when he gave evidence before the CFTC inquiry.
And people will say, well, and you've heard it today, there's not that much physical metal out there. There isn't. But in the physical market, as the market uses that term, there is much more metal than that. There's 100 times what there is.
Each ounce can produce 100 times its income. That's in commissions, and that's in turns, and it's in bank fees and all the rest of it. So this is a very lucrative business. You don't need a lot of gold around, or silver for that matter, in order to get these enormous figures. And that's the point. But we need to have more information, basic information about the market, about who's doing what, where the physical stock is, what the actual deliveries are, and so on. And deliveries, particularly, let's say, between banks and their customers, that I would like to see separated out, right. So that you can actually work out what the flows are, and from there make decent market deductions. But at the moment, these figures are just completely meaningless.
Yeah.
Well, why wouldn't the Chinese and with the Shanghai Gold Exchange, or Dubai with the Dubai physical gold market, and the new Russian physical gold market, and the new Singapore physical gold market, why wouldn't these guys be concerned about this electronic fix? Why wouldn't they be stepping up and questioning this, or at least just questioning it?
I think the answer to that, Rory, is they're beneficiaries of all this mess. They're developing markets in their own sort of particular areas, and it would not be so easy for them if London was so blind, I think, about the future. If you look at Dubai, for example, the Arab wealth comes from oil, and that goes back to the early 1970s. They have been accumulating gold in the Middle East for a long time. There are huge, huge amounts of gold in the Middle East. Dubai is also on the road to India when it comes to dealing and supplying gold. So they are very ambitious now that they know they've got all this gold around them. They've got, big markets sort of fairly close. I mean, Iran is going to be opening up. You've got Turkey and so on and so forth. I mean, these are big markets that they can interact with in the Muslim world. And this is what we've got to compete against. I mean, the physical is now moving out from London. And if you look at China, China herself keeps, and I'm pretty certain of this, all her own mine production. She refines an awful lot of gold for other countries, like Mongolia, for example. And presumably when we walk out of Afghanistan, she will be mining in Afghanistan and refining that and keeping it. She's going into places like Australia, like Africa, and doing deals or buying mines. And guess what? She'll end up processing it and keeping it. So how much of the world's production is available for markets like London? I see this as a declining quantity. And if London is to really maintain its position as a premier market for gold, she's going to have to reform, and I think reform very, very substantially.
Why would they even listen to London or New York or the CME group as far as pricing? Why wouldn't at this particular point, as you noted earlier, that the Shanghai Gold Exchange has very detailed information about the movement of actual physical gold? Why would they even consider the price coming out of London or New York?
Yeah, well, I think that's right. I mean, the price in London is the price in London, and presumably it's between the participants there. But if the participants decide that the market isn't in London, they're going to go to Dubai and they're going to go to Shanghai and Singapore and Hong Kong. So, it's where the participants go. And I think that unless we get this right, they could well be off, as it were.
The bail-ins are real. They are unfolding. We're going to see them in Detroit with pensioners. We're going to see them. We saw them in Cyprus. What is your take? Give us an update on bail-ins.
Well, bail-ins basically can only really occur where you have got a bank insolvency. I mean, if we're talking about banks, where you have a bank insolvency which is not a systemic problem in that it's unlikely to go much further than that particular bank. So you've had a number of bail-ins with Bankia in Spain, for example. I mean, it hasn't been quite put like that, but basically Bankia started off as 7 property lending banks, and they got into trouble. They put them into one. Depositors found that they had preference shares, and then suddenly there was another crisis. I mean, they've lost their shares about 3 times in effect, and that has become really a bust government-controlled vehicle, I suppose. The most obvious bail-in, which really did destabilize markets to an extent I don't think we fully appreciate, was the Cyprus bail-in. Mm-hmm. In the wake of that, we had 2 banks, ABN AMRO and Rabobank, the Dutch banks, who apparently turned around to their customers and said, we can no longer deliver gold. Now, this is to their unallocated account customers. So, in effect, they were declaring what you would probably call on the CME force majeure, if you like, over their unallocated accounts. Now, they can do that because the standard LBMA contract allows a bank to deliver cash if it is unable to source bullion. And they would have to give their customers notice. So you have to ask yourself, why did that occur in the month after the Cyprus bail-in? Now, the Cyprus bail-in, I think, alerted everyone who hadn't actually thought about this or paying attention that if you have a deposit in a euro bank, which is more than 115,000 euros, that was likely to be taken in the case of the bank insolvency, and used to refinance the bank, in return for which you would get shares. That is the bail-in. Now, obviously, if you've got quite a lot of money on deposit and you're worried about the banks and you're thinking, so far, don't worry, the government is going to bail it out, so my deposit should be all right, suddenly this becomes, a better worry, because actually what the government's going to do is going to take my money in order to finance the bailout. Then you start thinking about where your deposits are. You should move them from banks that you're not, that you're worried about. And of course, these deposits also include not just cash currency, but also cash gold, cash silver. So where you have a bullion, an account with a bullion bank, you also start thinking about the status of that. Now, if you get a bail-in there, then you're just going to lose your gold, you're going to lose your silver. Not that you've got it, because you actually are a creditor of the bank. So I think it was that led to the problems that ABN AMRO and Rabobank had at that time. So if they had these problems, they were unlikely to be the only banks who found that their customers were demanding the return of bullion against their unallocated accounts. Now, I think that also explains why there was a central bank coordinated effort along with the bullion banks to smash the price of gold in mid-April last year, in 2013. And I think from that sort of, if you like, fits in everything in terms of events to take us to the current situation where because they have got everybody in the West very, very bearish, there has been a continual tendency for these unallocated accounts to wind down. So that being the case, we're now in a situation where these unallocated accounts are probably as low as they're likely to be, and we now have the question of bail-ins coming again. Now, I don't think that this necessarily is going to give quite the same headache that we had in April 2013, but nonetheless, you could find that a number of banks find that their customers start, requesting money in. And here, this is interesting. We've got Germany. The cabinet there have approved the bail-in procedures, which will be brought into law in the new year, I understand. So any wealthy German depositor has been alerted again to this bail-in thing, and maybe might even be looking at his situation with Deutsche Bank. So bail-ins are now, I think, likely to begin to affect the bullion markets as people begin to think this is a risk. And Portugal, of course, happening this week, has again rubbed that point home very, very, very dramatically. Yeah. So these are interesting times, and I think that the unallocated accounts, while they're not as big as they were, I mean, the point behind this is that if people decide that they're going to go and buy some gold or buy some silver to protect themselves against the situation, the point you made right at the beginning, Sean, you can actually swap worthless cash for real money. If some people begin to take that view, then I think the run on the available stocks in the West could be very, very sharp, because these people are not going to do it by the way they did it in the past, which is, we think there's a bull market in the making here, so I'll go and open an account with whichever XYZ bank, bullion bank, and have some gold unallocated because I think I'm going to make money on it. Right. It's not that anymore. It's going to be a question of, the reason I want gold and silver is I actually don't want to hold money, currency money. And I don't trust a bank to provide me with gold and silver where there's a contract that says if they get into trouble, they can give me cash instead. What's the point?
Yeah, that's right. And I just want to flush out this idea that when we know that the U.S. government currency, the dollar, isn't worthless yet, in the sense that there's still confidence in it, and you can go to Target and you can go to wherever you'd like and buy gas for your car and exchange it for goods and services. But my point is, on the precious metals, silver specifically, really, is that the fraud in the markets have artificially lowered this price on silver to $20, which to me is stunning, when we know that there's at least 100 times paper in the market, as Jeffrey Christian has said, as you noted, Alasdair, and according to Nicholas Larkin, maybe it's far worse than that. Maybe it's 250 times just in 1 year. My point is that the market is so fundamentally flawed, and the malfeasance has led to artificially low prices that to me are stunning. And you know what? I don't own a gold and silver bullion company. So I'm not talking my book. I'm really truly not. I'm talking about fraud that's so epic that I think it will cause people's jaws to drop once the truth is made known, once the dollar dies. We talked to our friend Dave Kranzler recently, Alasdair, and he said his fear is that most Americans will not wake up until their dollar crashes. And I think he's right. And so for those that are new to this information that are listening, I really truly think that the criminals, those that have manipulated the prices of physical precious metals to their own ends, have given you an opportunity to go out and get on board this thing at artificially low prices. And when you can't even trust the banks to safeguard your money, you can't get a return in your savings account. And now, Alasdair, as you know, negative interest rates have struck. And in Spain, they've announced their intention to create a tax on bank deposits. Holding gold or holding silver in physical form is the opposite of Warren Buffett's argument, which is it's a barbaric relic that does nothing, it has no interest income, there's no reason to own it. It's the opposite of that now, because now you can actually get a positive interest rate if they're going to start taxing bank deposits. It's all stunning. And I'm going to be quiet now because I know that Rory has some questions. We're going to lose you soon. You guys can just take this wherever you want to go.
Thank you, Sean. Alasdair, I'm been looking at other currencies, and this kind of piggybacks on what you guys have been talking about as far as currency, or what Sean was saying. People have said that we shouldn't own, or that we should diversify out of U.S. dollar currencies. I mean, should I own, as a United States citizen and living in the United States, should I possess other global currencies like the Russian ruble, or should I have some euros in my pocket, or is that going to do me any good?
If you want to speculate in foreign currencies, then you take your life into your own hands. All currencies suffer the same inflation, if you like, of their quantity. I mean, look what's happening with the yen. We know what's happened with the dollar. We've had QE in the UK with the pound sterling, and the euro has so far avoided QE in the direct sense. But my goodness, they've managed to manipulate flows so that they have got the cost of government borrowing right down. And they're now talking about negative interest rates. Well, they've got negative deposit rates as it is for the banking for the banks from the borrowing from the ECB. So all currencies are in exactly the same boat. Now, if the dollar was to collapse in terms of its purchasing value, then I have no doubt in my own mind that would take all other currencies with it. Now, whether in the circumstances the euro doubles or halves, I think is immaterial, in dollar terms, that is. But they are actually all in the same boat. And really, if you're going to insure against that systemic risk, then there is only one asset which has so far not moved up to discount it happening at all, and that is gold and silver. And when I look at the value of gold relative to the quantity of fiat dollars in circulation, I haven't seen gold this cheap since the late 1960s when the London gold pool failed, and that's why the gold pool failed. I haven't seen it this cheap since 1999-2000, when the price, after a long bear market, came back to under $300. It was this cheap also on the 31st of December. So again, you know, we are in this ultra cheap territory, and you know the amazing thing is that nobody, because they don't know how to value gold or silver. Nobody really understands it.
Yeah.
But if you understand something about valuing gold and silver in paper currency terms, then that's the way you've got to look at it. And that is why I think that the price of gold and silver has not only bottomed, but has the potential to move up quite substantially. And that is even without, if you like, a systemic crisis. So the cost of your risk insurance against the whole world going belly up is actually as cheap as it's ever likely to be.
Yeah, and I just want to talk about the prices of silver and gold right now before we let you go, Alasdair, with gold almost at $1,340, safely above major resistance at $1,300, and silver closer to 21.40, 21.41, 21.35. What do you think is the significance of these benchmark prices? Because I don't think it was very long ago that somebody, and I do not remember who it was one of these establishment negative gold guys, said that gold would not see above $1,300 again this year. And here we are at 1340. What is the significance of these levels and gold having breached these major resistance points?
I never make price forecasts because actually the way I look at this is it's not gold and silver going up, it's paper money going down. And obviously paper money goes down at different rates against different things. There is a tide, if you like, that is going against paper currencies. The people who have been knocking gold, silver, platinum, whatever, are the same people who are knocking base metals. And they came up with this story about copper, how copper is missing from warehouses in China, and there have been all sorts of shadow banking shenanigans and all the rest of it. Net result is that there's going to be lots of selling of copper. Pardon? Has this happened? No, what's happened is that the price of copper has actually gone up. So I think what we're seeing a lot of the vested interests, if you like, who have basically got these markets horribly wrong. And I think that part of the reason that they've got it horribly wrong is they don't actually understand what happens to money itself, currency. And these currencies are, I think, in terms of their commodity purchasing power, tending to go down, and they're tending to go down quite sharply. I know it doesn't look like it in oil at the moment because you've had quite a fall off in the price of oil over the last week, but I don't think that fall off will last terribly long, and I suspect also that things like food and so on, all these basic materials, you'll find that for various reasons, each one perhaps explainable on its own merit, the price is going up. But the common factor in all this is that the currency in which you buy these raw materials, actually its purchasing power is going down. And I think we're on the cusp of that.
Yeah, you hit on something extremely important that we probably should have talked about, but I'll just mention it here since you hit on it, and it's this base metals hypothecation and rehypothecation and empty warehouses in China. It's really a stunning story, and I think it paints a very vivid picture of what possibly is going on and what we all think is probably going on in the warehouses for silver and gold. I think there's many behind the scenes scrambling to get their physical in those precious metals. Boy, I'll tell you, Alasdair, if you can't trust where the base metals are, how do you trust where the precious metals are?
Well, this is the other interesting thing. Guess who owns the London Metal Exchange? It was bought by the Hong Kong Exchange. And guess who owns that? Or sorry, where the vested interests there are. I mean, China's tentacles are immense, and I really do think that some of the investment banks who've got themselves into trading positions in the metals, they deserve what's coming, because we are seeing China extending her tentacles, her control over these things, in the most extraordinary manner. I wouldn't say that she's going to interfere in the pricing in the market. I don't think that at all. But I think one thing she is doing is she is ensuring that other people can't interfere in the pricing of the commodities upon which she relies. So I think that's a very interesting situation. Plus, I just do see these banks on their trading books. They're sort of pulling in actually quite a lot. You're not getting the big hits in the market that we used to get as little as 6 months ago. And I suspect that it's just getting too dangerous from a regulatory point of view, from a legal point of view, from a control point of view. And I just feel there's subtle changes in the markets going on in terms of how people play this. And I'm just so interested to see that most of the day you get no movement at all in gold and silver prices. They seem to move within $0.50 range, which in gold is really quite extraordinary.
Yeah.
So I just think that the people, if the people in the past who really tried to sort of shake the trees, think, okay, let's bash gold and see if we can shake out a few stops. That doesn't seem to happen quite so much now. I mean, I think this BaFin inquiry in Germany could be potentially enormous. And there was a German newspaper which writes in English which reported that investigation is extending to all German banks. All German banks have been asked to return all details of all dealings for their customers and for themselves as principals up until, I think, the middle of this month. So this is getting big, I think, and I just sort of think that, banks as a whole are sort of thinking, well, we really don't want to get too involved with these things, so they're telling their traders, I think, to cool it a bit.
Well, I guess this is probably a good place to sum up and say our goodbyes. I hope everybody enjoyed this conversation. I know that I did. Alasdair, you're always a pleasure to have on. You're such a gentleman, and we really do appreciate your time. Can you remind people where they can find your two excellent websites?
Yeah, well, it's always a pleasure being with you too, Sean and Rory. Most of the time, I'm head of research for Gold Money, so most of my stuff is published on that. But I also have my own website, which is financeandeconomics.org.
Well, very good. And we also know that Rory has an up-and-coming website called thedailycoin.org. Is that correct, Rory?
That is it. Thank you.
.org. Yes, you're welcome. Thank you. And I just want to thank you both for your time. I really appreciate it. I think these conversations are warranted and worth having because, again, most of the people in the society in which we live, our friends, our colleagues, our family, this is all foreign to them. This is a language they don't speak. And I think it's important to have these conversations and try to share them with those folks that, with the folks to whom this information is new, in the chance that maybe they will wake up, in the chance that maybe they will have time and find time and make time to protect themselves. I've always said you can't wake up until you choose to wake up, and hopefully more and more people will. I think it's going to become a necessity as the dollar continues to weaken and this global economic fiat empire comes crashing down. Our guest has been Alasdair Macleod from goldmoney.com and financeandeconomics.org. Alasdair, thanks again.
Thank you.
Thanks for listening, guys. Check us out at sgtreport.com. We do appreciate it. Have a great week. Bye-bye.